What is going on, Penny Boys and Gals? What's going on, stock traders? And welcome to another Penny Boys University Live. We do this every Thursday, 2 p.m. Eastern, with myself and, as always, Pookie's Revenge. How we doing, Pookie?
I'm good.
I knew you were gonna do that. I couldn't even. I was trying not to laugh, even asking you the question. I was like, he's gonna do the thing, isn't he?
I considered not doing it just to mess with you.
Well, I got the make some bread, and you got that. So everyone needs some. Right?
Oh man,
Porterhouse says every time.
No, I'm good. It's Thursday. The week's almost over. We've had a crazy week in the market and out of the market, so it's a good day for locking profits and learning psychology, brain stuff.
Well, yeah, and definitely, crazy markets definitely is the time to, red markets, crazy markets, volatile markets is the time to know about trading psychology, because that's where even the best technical analysts and fundamental analysts get burned.
It doesn't mean a damn thing if your brain ain't right.
Right. No, 100%. Not just with trading, just everything, anything in general. But yeah. I know you have some charts on the screen, but like we were saying, this is going to be a trading psychology class. We actually had a whole bunch of there's stocks, buddy, right?
Yeah. All right, we're doing SPY 0 days, guys. Let's go.
Oh no. Oh, Discord updated finally on my phone, and now I have no idea how it works. So there we go. I'm gonna post a schedule here for y'all, just so we all are aware. This is Trading Psychology Week. We're currently on week 7 of our Penny Boys University 8-week Trading 101 course for premium members. As you can see on the schedule, we already had a trading psychology class by Swinging Bull earlier this week, as well as by OG Nikki. She hosted a special trading psychology class. I did one yesterday. We have ours coming up today with myself and Pookie, as well as at 9 p.m. Eastern. Ethan will be doing a trading psychology class. So this way you can see a whole bunch of different just traders' perspectives when it comes to trading psychology. Because, everyone's emotions and just mindset, everything is different. So it's good not to just listen to one person only. It's good to have a whole mixture of just different mindsets and people to listen to. I know Nikki, she's saying trading psychology is my favorite. I know she's a psychology major, sociology minor, I believe it was. So yeah, so she's the best one out of all of us, which is why I was so excited about that Monday class we had earlier. But I see Stock Buddy on the screen. We can, I guess you can filter through some different stocks, and if you see any entries live, of course we'll call them out. And it is during the trading day. But I just want to get because everyone who tuned in, and there's a recording, are already in the free education where the live classes are. You can find them all here. I just posted that in the Discord. But I already did a trading psychology class. I talked about how everyone gets to 10 differently during that class. You can find the recording there. Some people do 5 plus 5. Some will do 11 minus 1. There are multiple ways to get to 10, just like there are multiple ways to multiple ways to get to your 10 out of 10. As for traders, that's the financial freedom, confidence in your trading, being able to have entry and exit plans, whatever that 10 out of 10 for you. For trading, just because somebody might be doing it, 5 plus 5, maybe it's options trading or day trading, doesn't mean that you have to do it that way. And no one way is the right way. Everyone gets it 10 differently, but y'all can check out that class in the live classes. There's Quench's way to get to 10. But yeah, the whole point being, we have a whole bunch of different traders here. We have Bull, we have Mr. Stockfly Profits in the chat currently. We have you, Pookies, we have Jay, who he has a charting master course that we have. So if you want to see his way of getting to 10, definitely check out that channel right there. We're currently on week 7 coming up today at 5 p.m. Eastern, going over indicators and time frames. And there is Big Quench. He also has a way to get to 10. And I was going to say, Austin, Big Quench, for those of you who don't know, is our fearless leader CEO. You can also check out his streams every Monday, 5 p.m. Eastern. He also has his way of getting to 10. Everyone, like I said, has their own way of getting to 10. I know Swinging Bull does it with his options trading. He has his Tuesday weekly options spreads workshop. So the whole goal here is, obviously, if you want to, you can tune into every single live class we have. I believe we have over 9 live education streams, and then we have 11 to 12 live trading and market review streams. So you can go to all of them. The more the merrier. Or you can find which person resonates best with your way of getting to 10, and then really follow that strategy. I know Pookies, you do your rags to riches as well, which is definitely worth checking out. That's definitely a really cool way to get to 10 using that dividend income. But let's get to the trading psychology. Yeah, the trading psychology aspect of the class, because like I said, I already did my class Wednesday, so today's more just about you, Pookie, and seeing just what is trading psychology for you, to you. What's something that you want to, I guess pass on some wisdom that you've learned throughout your years of trading, the ups as well as the downs. And let's just get right into
all the downs.
and
Yeah,
all
so
all of that.
so trading psychology at the end of the day is just a way to understand things, right? Yourself, the market, the way you react to the market, just the way that we kind of interpret things and process them, right? So when we talk about trading psychology, as far as like, what kind of steps we can put in place, what we call things, those are just filters that teach us how to get out of our own way. And if we don't have that in place, none of this stuff is going to matter. Like nothing at all is going to matter. I can tell you, wait for a higher high, then a higher low, then grab an engulfing candle with increasing volume and place, 10% buy of your portfolio. And you would be net profitable in most cases, more often than not, over time. But what do? Right? We're humans. We have these fears, right? People cut profits early because they want to avoid the fear of losing them. People hold things because they have hope and they compromise. It's the fear of realizing the loss, right? So we have to understand the fear, where it comes from, what causes it, things that we can put in place, like specific rules to work around them rather than trying to fight against them and making ourselves even more stressed out. So it's just a way to kind of build your framework. And if you have a solid framework, you're going to have solid structure in your market. So you'll be less likely to get caught off guard and less of a victim of impulse and circumstance, basically. So that's what it is for me. It's also a great way to reframe how you view the market and your role in it. So, for example, a lot of people are in the habit when they first start of trying to make their profits bigger and not making their losses smaller, and that really hurts them. The sooner you focus on making your losses smaller, those profits, whether they're big or small, they'll count for more. And then you'll also have a better time at tax time. So, everyone wants to make money. They're in a hurry to make money because of how we're wired as humans, and that's totally okay. It makes sense. But you can try to make money fast. And most people end up being okay losing money fast rather than making money slow. And it's just you have to be aware of it, and then you can turn it upside down into your favor. So that's why we're here. That's what the education's all about. And it's not just, put in the work and, you should have done this, you should have done it. We try to give you specifics so that you can build your own pathway and then follow it. I can't tell you what's in your brain. I can only tell you what's in other people's brains and what's in my brain. Ultimately, that's going to be between you and the mirror.
So I'm curious, just because I know with these Thursday classes, a lot of the times I'm just kind of throwing curveballs at you with just random questions. But and you usually always are actually on top of it when it comes to these questions. I've yet to stump you. I'm not gonna lie.
You try.
Neither has any of the members. So that's a challenge for any of these Thursday classes. Anyone can stump Pookie with the question when it comes to trading. Now I'm really putting you on the spot. But I know for us, we teach charting, we teach fundamental analysis. I'll more so just talk on the charting aspect. We understand how support and resistance works, how trend lines work, how Fibonacci works. We understand how to find levels of interest, whereas some traders just don't. And they're just trading based off of, just strictly their emotions, because, either they're new to it or they just, they haven't taken courses or whatever. They just see, candles going up, stocks going up, stocks going down, and they get in based off of emotions, based off of herding behavior, loss aversion, FOMO. So I'm curious as, because I know I always see people talking about trading the market's emotions. Of course, that means trading, those people's emotions, the people who don't have the knowledge that we have, or StocksBuddy, for instance, and they're, they're not selling based off of a target. When StocksBuddy gives you that bear signal, they're selling based off of just random hopes. I hope that I can make this amount of money. I have no reason why this should happen. So, what are some ways that we could trade possibly, either herding behavior, FOMO, loss aversion, and how can we see that play out in the market when it comes to the candle patterns and all that kind of stuff?
So we see it all the time, and it's not as random as you'd think. It's specifically structured. It's social engineering. So if like with the Bitcoin craze, for example, people saw their peers making a ton of money, and this was all survivorship bias and confirmation bias. So it's not like everyone was making money. More often than not, people lost money. But the success stories that you see compel people through FOMO to try to participate and make that same end result. The market relies specifically on that FOMO aspect to separate people who are impatient and undisciplined and don't have a structured plan from their money, because that's how they pay their bills. That's how they make their money for their firm. they keep their boss happy, they keep the market going, right? They need volatility. They need people to liquidate for losses sometimes. Otherwise, they won't survive. So if you see like a momentum breakout or a gap fill, that is herd mentality, Fibonacci retracements, anything that's Pygmalion effect specifically, and that's just the self-fulfilling prophecy. That's herd mentality. It's people that are just going with what they know based on what they're seeing in their peers. So we see it, and we can also, and recently here in Premium, we've been sharing how to identify those areas as hunting grounds for institutions, because institutions have to get filled at certain areas because that's where the liquidity is. They can't get filled. Like if we're if we're looking at this chart right here, for example, there's a nice liquidity zone right above here because all the shorts have their buy stops up here. So they need to hit those buy orders so that they can match them with sell orders and then push the price down. They can't really get filled significantly right here, or like right here, for example. So it's just little things like that, like waiting for people to walk into those traps and then identifying that there is in fact a bigger participant there, and then letting everyone basically get messed up. You're sending your friends in as bait, essentially, watching them get messed up, and then you follow the institution home where he's got his big pile of gold, and then you can participate just like he does. So like right down here at the bottom of this chart, there's liquidity. I don't have a hotkey set up, so I'll just have to draw it here. Oops, that's trading view. All right, so there's liquidity zones here, and there's one up here as well. So when the price gets out of this little range that it's in, there's going to be stop losses here, and there's going to be buy stops up here. Okay, the buyers put their stop losses here because they don't want to be in the trade if it falls down. Okay, that's selling pressure. Shorts have their buy orders up here because they don't want to be in a short position if the price breaks to the upside. So those are buy orders. So institutions will ram the price up through these levels, hit those buy orders. They'll match them with sells, slam the price back down. They'll hit this liquidity zone here. And if it's somewhere where they want the price to pivot, that is. Otherwise, they might just accumulate and let it release a little higher. They'll slam these buy orders, match those with sell orders. Or I'm sorry, sell orders match them with buy orders, and then lock the price in this range. And that's what you see a lot of times in these kinds of channels. You're just seeing lower lows and flat or maybe higher highs and things like that. It's all just accumulation before the bigger move. So whether it goes up or down, we don't know. We can't predict that. Nobody ever can with confidence. Anyone who says they can is full of it. It's all about just waiting until you identify the specifics of where these bigger participants are and not trying to forecast things. So that's why we harp so much on confirmations and letting trades go if they don't fit.
No, that definitely makes sense. And I know you're talking about the different channels and all that. I know yesterday we were talking about the different types of traders out there, just types of ways of trading. When it comes to trading these trend lines or support resistance lines. I just want to go over each of them just with you personally and just see different ways that maybe people let their emotions get the best of them, things that we could probably ideally, hopefully try to avoid. Starting with, so we're going to be talking about momentum trading, reversal trading, breakout trading, and then range trading. Let's start with momentum trading. I'll let you actually explain it in your words because I already did my class yesterday with that.
All right, so that's the easy one, right? Because when you have, let me just kick it back up to the 15-minute here, and I'll just kick it down to one chart so we don't get confused. Okay. So when we're looking at a chart, right, you get an impulse and then a pullback, right? That's always easy to identify. You've got this big move up here, and then you've got the pullback from that. So right here, okay? I hope everyone can see my screen. If you can't, please say something in the chat. This establishes a range, okay? And this is where we see supply and demand. So we've got supply up top. They have shares. They want to sell it for money when the price is at their value where they want. And then down here, you've got demand. People have cash. They want to buy shares. So neither side is really willing to let it go. And in reality, we know it's just institutions controlling the price so they can harvest and accumulate. So when one of these zones fails to be defended, you've got all these sell-off, these stop-loss orders that are set to sell. Okay, and we talked about earlier about the institutions matching those orders. I'm having a stroke over here. Matching those orders with buy orders so that they can lock the price in the range and accumulate for their bigger moves. If they don't defend one of these liquidity zones, that's just straight sell orders. And then other bears will jump in and it causes a momentum breakout. And that's when people just pile on for the big impulsive move. As soon as that move starts to slow down, they'll start locking profits. It'll reverse and you get another range. That's a displacement. And you'll see that the market typically trends, and by trend, I mean it's locked in a range here about 70% of the time. So if I draw another level right here, just kind of plotting out where the ranges are, you can see it's kind of here a good chunk of the time, and it's displacing a short amount of time. So there's displacement versus range. And that kind of really dictates what kind of trade you should be looking for in a lot of cases. So if you see something's in a channel like this, you're not going to try to buy it here in anticipation for a breakout. You'd really want to see a retest of the zone and then a push, or you're going to be looking for bear entries inside the range, because that's statistically where it's likely to go until that range is broken. Once it's broken, you take a small stop loss if you saw a confirmation and took an entry, and then you'd look for that momentum breakout. There's also gap fills, which tend to have momentum, and that's just unresolved price action. It's just a discrepancy between supply and demand. That's all it is.
Right. And that's with the momentum trading. Of course, there's two ways to do that. You can either trade with the momentum, just trading, waiting for the trends, buying during a strong trend, and then of course selling ideally, when that trend starts to show weakness. And then of course there is breakout trading, like you're talking about, when you find that trend and wait for the breakout of the trend. Let's talk about range trading, because I know you were just mentioning a bunch of ranges, and of course we'll get to the next one after that.
I love range trading. So, what stock was I just looking at?
Yes. I don't know. I wasn't looking at the stock that you're looking at. I was listening to what you're saying.
It was WFC, Wells Fargo. Only because it's a good example, right? And I just kind of went through exactly what range trading is.
Yeah.
Market is going this way, flat, about 70% of the time. So for range traders, all you really got to do is look for confirmations off the support levels and short sell off the resistance until the pattern is broken. This can happen any number of times. There are a couple tricks to it. You want to make sure that the range is nice and wide. You don't want to trade something like this where it's just there. It's not good. And you'll just be part of that retail where your stop loss is down here or your buy stops up here, and you're just trading this gap over and over and over again until they accumulate enough and release the price, at which point you would be out of it when everyone else is trying to jump in.
That's that. Yeah.
I
think range trading is probably the most straightforward one out of the four that we're talking about. Of course, being range trading, breakout trading. We just talked about, of course, momentum trading earlier. And then reversal trading, which is the one that people love, and the one that people really get caught up on, especially with those emotions. And you want to go over reversal trading next, and maybe some ways that people might get caught with false. And actually, we can get into false things, false breakouts, false reversals, and all that after. But let's go over the basics of reversal trading first.
Yeah. So there's a couple different types of trading. So when you look at a range versus a displacement, that's more structure oriented. So you're typically looking at flat levels to break. Momentum can be structural or it can be dynamic. So you can look for like a wedge breakout, for example. That's a momentum setup. That is slightly different than a reversal in a lot of cases. So a reversal in the context of a trend trader would just be, or a range trader, I'm sorry, would just be when the range breaks and it pushes back down in the direction it fed into the range. So for a trend trader, a reversal is going to be slightly different. That's when you go from seeing higher highs and higher lows to lower lows and lower highs. So when you see that, ideally in a higher time frame, let me just kick it up a little bit. Well, we didn't really form one here. So let's just look at this one, for example. Here's a lower low, here's a lower high, here's a lower low, lower high, lower low, and then we get a higher high. So this invalidates that portion of the downtrend. So this was lower low, lower highs. Over here, we're looking for higher highs, higher lows. So we're forming a higher high right now. Then we'll ideally seek a higher low, and then a push above that would be the entry opportunity for a bullish trade. So here, for example, we get a higher high right there, and you can look at Stocks Buddy. It's got the lines on there for you. If you can see, it's kind of. Let me just change that really quick. The line width. Oh, I can't do it on this one. Crap! I got the other version. I'm sorry. But you can see this line has a positive slope and this line here has a positive slope. They just point to they describe the relationship between the highs. So in this case, we get a higher high and a higher low right here. And that's it. That's all you have to do. And then this bull signal right here, in theory, would be the entry opportunity, and you'd have a stop loss right down here, and then that's your trade. So that's kind of the easy way to identify a trend reversal, is going from lower lows, lower highs to higher highs, higher lows, or vice versa.
I know you're going in between time frames. That stock buddies indicator that works with both any kind of time frame, right? It doesn't really matter which one you're using.
Yeah, any time frame, any type of instrument. It works on forex, it works on futures, it works on basically anything that can be charted. The only caveat is if you're using like a free subscription and you go to like the lower time frames, there will be gaps in the price because you don't have the data package. But you can get that all for like $20 a month on that.
Okay.
You don't need it though. That's what I'm trying to emphasize. You just stick to the higher time frames and you'll be fine.
Yeah, I know. I always get a lot of questions about what time frame is the best, and so for those of you who do have that question, there definitely isn't one, but it's good to know how each one kind of works and how different traders could use them. I know Jay in particular, he likes using that weekly time frame, the 4 hour. I know you personally might do some do different time frames, like then maybe bull, then maybe big quench. But for those of you just wondering, yeah, it depends on the trade, of course. But those of you who are wondering, how the time frame works and maybe possibly what BTCJ strategy is, we do have at 5 p.m. Eastern in this area right here, the lounge, we have a time frames 101 and indicators class with Jay. That's going to be coming up in like around 2.5 hours here. But just speaking of the Stocks Buddy indicator, I see all the buy and the sell signals. It's definitely a really good way to get the emotions out of it because you have clear entries, clear exits. Can we go over maybe some false entries, false exits that might have stemmed from possibly emotional trading that maybe the Stocks Buddy indicator, just an informed trader might avoid when it comes to possibly either false reversals or false breakouts or possible trend breaks and all that kind of stuff?
Absolutely. So this one right here, for example, this bull signal right here. Let me zoom in a little bit. Remember, because the overall setup here is going to be a trend break. We're in a channel right now. So if you see a signal like this, I mean, the indicator can only do so much. Any indicator can only do so much. So you really need to compare it. You need to combine it with proper technical analysis. Now, it doesn't mean you need to be like a master trader, but at least knowing some levels and some concept is much safer because you're going to be taking fewer false entries. So in this case, if we're trading this range, right, and we know that we want to trade, let's say we cut this in half, right? Let me just cut this level in half, and I'll make it a dashed line, right? So this is the only thing we're looking at right here is just this range right here. Okay. If we're looking to trade bullish trades off the support level and bearish trades off this resistance level, this guy is out of place. Okay. We don't need to take that because that's just higher. It's just indicating that there's some indecision in the price action. Same with this one. Anyone who's traded the BAC strategy, for example, knows you wait until the candle's above the moving average or below the moving average and take the direction that it goes. This one right here, this recent one, we don't need to take that. That is above the halfway point, which means we have disproportionate risk reward. And in this case, since you're using Stocks Buddy, you have the stop loss in place. It's an adaptive stop loss, so it's okay. But it's still not good practice. So obviously the better setups are going to be down here. Like this guy, even though it was a stop loss, that's a more disciplined entry because you waited for it to come down. This one's a better one. This one's a better one. This one's a better one. This one, not so much. You know what I mean?
Yes. Was that a question?
It is now. So that's the idea. Is you want to combine it with things that you do learn and you want to continue learning and not just rely specifically on one indicator, because no matter how good it is, it's not going to do you any good if you don't have structure in your trading.
So cycling. Oh, are you? Do you have any more on the?
I forgot what the original question was.
That's totally fine. I got a new one for you, actually. Just cycling back to trading psychology. I forgot my question now. It was about trading psychology, and what were you just saying? Now I totally forgot what it was. Now I just lost it.
This is good.
I went to go think about the original question. Like, oh, I'll remind him the original question. I forgot the question I was just about to ask. Wow, he was there a second ago.
It's okay, buddy.
It happens.
Yeah. So
think about it for a second.
Well, you're talking about like the false signals and stuff.
Well, yeah. That was the original question. Yeah.
Yeah, and honestly, like the best approach that I am aware of to make any technical analysis more valid is to use multiple time frames. So, you were saying that the
I remember.
There's a bunch of different like stances on it, but you only really need 2 time frames. You need a higher one and a lower one that makes sense, right? So if you're if you're doing top-down analysis and you start with like the weekly or the daily time frame, plot your major levels, then you're looking at maybe the 1 or 2 hour to determine like the short-term bias, and then maybe the 5 minute for your signals. you can use all kinds of different indicators and be wildly successful. The problem is people aren't really patient enough to do that. So we end up in situations like this where we're in a channel and we want to trade something now, and we say, "Oh, it's going to break out. It showed weakness up here. We're gonna blast. We're gonna seek new highs and all that." So they take an entry like right here, and then it gets down here, and you're like, "It's just below the new low. It's a liquidity sweep. It's going to blast, right?" And then it's down here, and you're like, "Oh, there's another liquidity zone. It's going to blast." Or maybe it'll bounce off the support. We'll go for a quadruple bottom. Or, it's entering a momentum zone. It's a fair value gap. It's going to blast, right? And then before you know it, you're down here, right? You're $2 down per share, and you're trying to figure out where it all went wrong. And then you feel bad because you're like, "Oh, I should have never held that. I see that. I'm an idiot." And then you beat yourself up, and then you do it again, right? Because that's the nature of the cycle in our brain.
So I know Black says he goes to the gym while he's waiting on the 4 hour. That's how you double your gains.
That's the way to do it.
Gains in the gym and your gains in the portfolio. So I do remember my question, cycling back to trading psychology.
Oh boy.
During the class yesterday, we were talking about you and Jay and Austin and Lee and all of our shot callers, Bull, all their different objectives, goals, the way that they trade. For you personally, this is based off of our trading plan class we made a while back. But for you, under what is my approach? It says, this is your quote, "I heavily prioritize risk management and diversification. Less is more, and I put my focus on emphasizing the growth potential of each dollar rather than taking larger risks than necessary to optimize the power of compounding gains." I want to talk about the growth potential of each dollar part there. Yeah, because when it comes to trading psychology, a lot of those emotions come from people either over allocating funds to certain aspects of trading that might be a little bit too risky, either just for them or just in general. You can come just from over allocating just in general into a trade. There's a lot of ways that people, maybe overthink how to, utilize that dollar to the best of their advantage, and then because of that, the emotions start flowing. So I'm curious, what do you mean by that? How does one do that? And what's your strategy behind that?
So every single one of my dollars is like a little Pokemon, right? I want it to go out there. I want it to have a good time safely, and I want it to go make babies. Right, that's the goal.
What? That's not how Pokemon works.
I might have downloaded the wrong game.
You don't. What?
Anyway, back to what I was talking about.
Okay.
Well, okay. What? So think about it this way, right? My goal.
Hey, I don't get that at all. He thinks that the objective of Pokemon is to have them grow, make them grow, and then have them have babies.
So you're gonna have to watch the recording. So I was saying that my view of every dollar in my account is that it's like a little Pokemon. I want it to go out there and have a good time, be safe, and make babies. That's what I do.
I don't think that's how Pokemon works, though. No, they battle each other.
Pokemon Gold. Pokemon. There we go.
I've never gone to the game thinking like, "Oh yeah, I'm gonna make this Pikachu have so many babies."
You got to know the right buttons. There it is. So it's the same thing. Yeah, Chris, we lost him. I've played Pokemon. No.
Clearly, you played a different version of Pokemon.
Well, either way, it doesn't matter, right? You're taking your Pokemon, you're sending them out there, they go beat up other Pokemon, and they come back with babies. Yeah,
with berries.
All right, so if we consider the approach that that we take for the dividends, for example, right? So just you can apply this mindset to like any strategy, and the goal is to just maximize the dollar invest by percentages, not just throw a bunch of money at it and hope it sticks, right? So if we look at like, let me just go down through these real quick and I'll see UVE, for example, that not the best example. It's fine. I'm still net profitable, but it was adjusted for dividends. So it's going to look weird until I explain it. And that's going to be a tangent. So my notes went away for Kim. Anyway, Kim is the one that I've traded 4 times, I think. So basically the idea here was to buy the stock right before the ex-div date, hold the stock through the ex-div date, sell, and then get the dividend payout in January or December 21st, right? So all I did is I bought it somewhere around here, right? I think. And then I knew how much the dividend was going to be on this day. So all I did is take it and I put it back here when the price went up. So I set a sell order for that same amount. That eliminates my need to hold it through XDiv, but I bought it again, right? Because I'm still just, I get my original dollars back and profits, okay? So maybe you buy it again here and you do the same thing. You're just taking that future profit that you would have over here, bringing it into your portfolio today and locking it in. You do that a couple times and I'm still using the same one share size or the same dollar amount, but I'm getting more and more multipliers of this same dividend payment that I was originally expecting. So I'm not increasing my risk. I'm just making my profits bigger by reinvesting it the right way. And now, since I've held it through XDiv, I also get this same payment in the future. I just got to wait for that day.
I'm not gonna lie, I wasn't even listening to you because the chat is just so funny. I'm like rereading the chat about the Pokemon stuff. I did hear you say something about dividends and ex-dividends. I want to just go over with you because I went over it in one of my classes. The possible, obviously, we aren't like advisors or bank advisors, whatever. But what is the potential difference between using an interest account versus using a dividend account to have your money passively grow for you, and what could the potential difference be? Pros and cons, of course, when it comes to risks factors, as well as obviously, we all of us know how savings accounts work, so the risks as well as possible reward that you can't get in an interest account.
Yeah. So here's a couple questions you got to ask yourself. A, is what I'm doing working? Right? Am I outperforming what I would normally get if I just put those same dollars in a savings account, which is 1% to 2% a year? If you're not net positive for the year, that's an opportunity to look for other means of passive income. There's no billionaire alive that isn't the result of passive income. So if you're not doing it, you're not going to get there. You're not going to be the first billionaire to just magically figure it out, right? So if we're learning and we're taking losses and we're inconsistent and we're struggling and we're human and all that, it makes sense to put the bulk of our money into something that's going to passively grow, like interest or dividends or some other form of passive income, like a strategy like the wheel, for example, if you're on a larger account. So it starts with a savings account, right? Everybody knows that you can just put money in a bank and they'll pay you over time because they're going to use your money too in the market and make more money, and then they're going to pay you a portion of that as an annual interest. Or quarterly. Sometimes they pay quarterly. If you can outperform that 1% to 2%, or if you find dividend stocks that can outperform that 1% to 2%, it makes sense to shift money into that because that's more aggressive. Even though it's still safe, it's more aggressive. And then you learn how to optimize that. And then you can incorporate other strategies like the wheel and covered calls and spreads and things like that that are more hedged, right? And then maybe you take that 5% that you were or even if you put your money in a broker like Robinhood or Webull, they pay you like 5% a year too. So that's even better than a savings account in most cases. If you put your money into a managed fund, they're going to make you about 5% to 8%, but you got to pay fees and stuff like that. So you're making less. So unless you have a pretty sizable investment, that's not going to be ideal, but it's still better than a savings account. So there's still these there's layers to this stuff. It's my washer. Sorry.
It's your washer, not your hot pocket.
I wash my hot pockets. So, if you get to the point where you can offset your, if you can outperform what you'd make on I hate that thing. I'm going to punch it. If you can outperform your savings account, like for example, I have $1,800 in this small account over here. That's currently up to, where is it? 1994. Now there's going to be some noise in there because we just had the XDiv adjustments and like Johnson & Johnson and Tesla are a little bit red and they're just my bigger positions. But overall, I'm still winning, right? Plus I get the dividend payouts pretty soon. So this is currently providing a 20% yield per year. Okay, so if you're not doing that and you're speculative trading, why not at least consider dividends, right? It's easy to do, very hands off, right? It's not safe. Nothing is ever 100% safe, but it's easier and it's a higher return than working your butt off all day trying to figure out the market, right? You can still do that and you can still practice and you can paper trade at smaller amounts, but this is automatic. I don't have to think, right? Plus you're paying a fee every time you trade a SPY option because Webull specifically charges you like $1.50 or $1.75. So for this month, I'm getting $35 for doing nothing other than holding shares. My annual income is increased by $383.40 for doing nothing, right? This is Netflix times 3. Okay. I don't pay for Netflix anymore. Now I'm going to take that $35 this month and I'm going to reinvest it. And I'm still making consistent contributions every month. So this number is just going to keep going up and up and up, but it's this percentage that I want to keep consistent. Now this is pretty aggressive. Above 20 is pretty pretty good. But if you compare it to a larger account like this one right here, that's 26%. I'm being more aggressive with that account. When I get all the stuff set in there, we're expecting a little windfall thing. My wife's going to start her account up. So you can see that there's just passive profits is nice. You don't have to think about anything. And of course, I have a lot of positions and stuff like that. It's also because I'm recording a YouTube series and I'm walking through all this stuff. So if you just want to hold 3 positions and put, maybe 10% of your account in each one, that's at least offsetting your risk, because, you still have 70% that you can trade with if you want to, but 30% of that's going to be there next month, right? And if you shift the numbers around and you put 70% in passive income, you'll start each month with 70% plus. You're not just going to be starting over every month. So that's the mindset I kind of want everyone to have, because you're going to hurt yourself. If you think you can only make money speculatively trading, you're going to hurt yourself.
Yeah, and like a lot of the people who are doing the rags to riches along with you, a lot of them are saying it's a great way to, especially if you're learning, how to trade. It's a good way to put your money to work for you without, like you just said, risking it with the speculative trading.
And you can still trade. Like you can still do stuff. Like you can still learn how to trade. You can practice with the candles, and you can practice with options, and you can practice with spreads and all this good stuff. And you can do it on smaller amounts. You're just not using 90% of your portfolio to try to figure it out.
Right. I mean, yeah, because the goal is to ideally be able to do both. A lot of the people who have, big incomes, they're bringing in their dividend income as well as their capital gains income from trading and investing. So it is very important to, to learn both skills. But while you're learning how to get that capital gains income from trading and investing, speculative trading and investing, it's really good to be able to have a way to, like you just keep saying, making your money work for you, because you have 2 options: either your money's going to work for you, or you're going to use spend time to make yourself work for you to make money. So
if I can be as efficient as possible, I'm going to be as efficient as possible. That's our duty as organisms. Our job is to eat, procreate, and have fun, right? So if we can do that efficiently, as far as the eating efficiently, procreating efficiently, and having fun efficiently, we're going to do that because it frees up time, and that's the most valuable resource we have. So, well, I didn't mean to click on that, but anyway, cat's out the bed. Don't worry about it. Yeah. No, so I shared this the other day in the Rags to Riches. This is not what I intend to share for everybody, but this is the end result of 10 plus years of investing and trading and putting in the work. So I gotta punch this dryer in the face, or the washer. This right here. Yes. Now, a little over, yeah. And that is because of various strategies. It's because of consistent contributions. It's, circumstances are good. Like, it's just being very efficient with stuff. Now, I don't like putting big numbers in the mix, because that puts people in the wrong mindset, because they're like, I want to make this. Yeah. Absolutely. Right. Ideally, right? Because there's going to be offsets and stuff like that. So, but yeah, that's the goal. Is you just better than you are today, every day, and give it time. It's progress plus time.
Hey, really quick, Pookie, let's end the stream before we go off the deep end, because Austin's not.
Yeah, I'm gonna end this washer too. Hang on, I'll be right back.
Okay, yeah. All right, for those of you who are watching after the fact, we are going to be live in the Discord. I will be posting this recording in this is a premium recording, so premium live stream channel. And for those of you who are watching after the fact, we do these live, like, after post stream or post education hangouts in the lounge or in the free live stream area, depending where it is. So definitely pays off to be here live and get the whole experience. So I hope to see you next stream, which is going to be 5 p.m. Eastern. Myself and Jay doing Charting 101, going over time frames, going over indicators. But we are going to stick around here in the Discord for those of you who are live and going over some of Austin's questions with this this account that Pookies has here. So we hope to see you next time. But until then, we hope that you all make some bread.